Can I just, let me see if I can try to do the share screen. Let's see if that works.
Sure.
Okay, can you see that?
Yes. That's great. It works perfectly.
Yeah, that's working.
Okay, very good. Great. I don't know if I'll use the slides, but maybe.
Hey, Caio. Okay, it's 5 in the afternoon, so let's start. 5 in the afternoon here in New York time. Well, thank you very much, everyone, for joining us this afternoon. On behalf of XP Investments and XP Investimentos, we have with us today, let me introduce you real quick, Andres Suarez. He is the one that helps us with all these technology issues. We have Caio Acevedo, CEO of XP Investments in New York. We have Fernando Ferreira. He's the Chief of Strategy and Research in Sao Paulo, Brazil, Equity Research. And we have the pleasure of having a very good friend of the house, Anatole. I think it was about this same time that you and I were sharing a very nice stage in Sao Paulo last year. And we were talking about global economics and the US elections and the trade war. So it's been quite a change in the last couple of last year time. Anatole has agreed to speak to us and join us in this conversation. Anatole is a great friend of the house. He's always been helped us a lot with our research and a friend, and we have a very nice partnership with Gavekal. We have had this very long partnership with Gavekal for a long time. Thank you, Steve, for helping us as well set up this call, and we have a very crowded participation from my clients all the way in the US, in Sao Paulo, in Colombia, in Mexico. So Anatole, you're a very popular economist. So thank you on behalf of XP Investments for being here. Just to tell everybody how the logistics are going to work, Anatole has agreed to have a very nice conversation with us. We're going to try to do like a round table situation. It's somewhat a little bit more difficult on Zoom, but we'll see how it works. Try to replicate what we did in Sao Paulo last year. And I will be asking some questions. Fernando will be asking some questions. Caio may be asking some questions as well. And we go from there. We have about 1 hour, and also we will be taking some questions from the audience. So please, everyone, if you want to pose questions, please do it on the system. You will see on the Zoom thing on the bottom something that says chat, I believe, and then you can press the questions. So Anatole, once again, thank you very much for joining us. And let me start the conversation with a very simple question. Let's put it that way. And the question is basically the following. It's like I was just checking right before I got in. The S&P had another great year, another great day today, as it has been having the whole week. I believe we're down 5%. The Nasdaq is up on the year, and at the same time, we listen to all this information about the virus and the damage to the economy, unemployment claims. North of 35 million people, and many of those claims have not been able to go through because of the difficulty in doing so. So clearly and this is a question that Ferreira and Caio and me, we all get all the time this question from our clients. It's like, what gives? What's the story? How come we have this situation in the markets, and at the same time we need to compare and contrast to the real situation in which everybody that lives in the US right now has either a friend, a brother, or a cousin who has lost his or her job. That's the reality, because it's almost 40 million people in a labor force of 150 million. It's just too aggressive. So we'd love to hear your initial comments on that very simple question. Once again, thank you very much for joining us, and the floor is yours.
Well, thank you very much for inviting me. I'm looking forward to it. I very much enjoyed meeting you the last few times in Sao Paulo. And, it will be fun to continue the conversation. So Let me begin by saying, for as long as you've known me, which is a few years, and some of your clients have seen me come out to Brazil for longer than that, probably for the last 8, 9, possibly 10 years, every time I've been coming out to Sao Paulo, with maybe one slight exception just before Trump was elected in 2016, I have been very bullish. I have basically had a bullish, constructive, risk-on view of asset allocation globally. No, I'm not talking about Brazil or specific emerging markets, but globally, and particularly about the US stock market. I've been consistently bullish for the last 10 years, since 2009. I've got to say, I am now not bullish. I think that what's happening in the stock markets today, which is exactly what you described, I think it is what's called, in England, a mugs rally. Now, admittedly, it's gone much further than I expected, but I think this is still a bear market rally, a cat bounce, whatever cliche you want to use. And even if it goes back to the highs of late February, and it's really quite close, as you said, the S&P is down 5% or so from the beginning of the year, but it's actually only down 10%, I think 11% at today's close, from the all-time high, which was reached at the end of February. The NASDAQ is only, I think, 5 or 6% below the all-time high. So we have US equities, at least in the aggregate, standing at the highest levels they have ever reached, except for the last few months. So we have a stock market which, at least in the aggregate, it's not just that it's recovered from, it's bounced back from what is, after all, the biggest hit to the world economy that has ever happened, not just in our lifetimes, but ever. It's rebounded completely from that, but it's also expecting, it seems to be discounting a future which is at least as good as it's ever been in history. Now, that seems to me an excessive reaction to, so you're asking what's the cause, what's really going on? I think two things are going on, which in the short term can explain the rebound, and maybe it will carry on for another 10% or 5%, who knows? One is that the public health situation has improved somewhat more rapidly than expected, at least in the Northern Hemisphere. Now, of course, are you sitting in Sao Paulo at the moment, Alberto?
No, Fernando is sitting in Sao Paulo at the moment. Yes.
Yeah, and yours, where are you sitting?
I am in Miami at this point in time. In
Miami, okay, yeah. So, yeah. But look, in Brazil, the public health situation is getting worse and worse, and actually in a number of other, Chile and South Africa. So it may be a hemispheric thing. Anyway, so the first thing is the public health situation in the Northern Hemisphere has improved, and the governments have ended their lockdowns a little bit earlier than a lot of people expected, but it's only a matter of weeks. The second thing is that the liquidity injections that have come from the Fed above all, but from central banks all over the world, have removed a lot of assets from the public markets, primarily government bonds, but to some extent even credit, through a number of the Fed's, in particular, schemes for buying bond ETFs and so on. And that has has freed up a lot of excess liquidity, some of which has flowed into the stock market. So those are the two sort of obvious explanations for what's happened. Now, the liquidity, I think we'll come back to. I think the liquidity injection is there for real. It's for real, and it's going to continue for at least the next year or 2 years. We're going to be an extremely generous liquidity environment, which is a positive factor for asset markets. But the point about the public health, which I think has been the main catalyst for this last rally, I think is a mistake. I think investors are making a mistake. Why are they making a mistake? Because what matters to asset prices, and particularly to equity prices, is not the public health situation, not how many people getting ill with coronavirus, or even frankly, how many people are dying of coronavirus. And what matters is not what date they end the lockdown in New York or Miami or London. What matters is the impact of all that on economic activity, and not just in this month and this quarter, but for the next 1 to 2 years. Now, we have seen so far no evidence at all about what the impact of the coronavirus is really going to be on economic activity over the next 6 months. We haven't seen any, I literally mean no evidence at all. I don't mean we haven't seen any good evidence or bad evidence. We have seen data, and we've seen some corporate reporting about what has happened in March, April, and early May in the Northern Hemisphere during the periods of lockdowns. In some cases, that has been worse than expected. In other cases, there's been a recovery which has been a little bit better than expected. But we have seen no evidence at all about what's going to happen in response to what you mentioned, Alberto. The fact that millions, actually tens of millions of people are going to come out of this during the summer or at the end of the summer holidays, unemployed, without jobs and without incomes. Tens of thousands, probably hundreds of thousands of businesses all over the world, mostly small businesses, but also a few big businesses, are going to come out of this, not now, but in 2 months, 3 months, 6 months' time, with completely broken business models and or unable to meet their liabilities. So there's going to be a tremendous amount of corporate restructuring, a tremendous amount of consumer repression caused by the need for higher savings among people who have either lost their jobs or are concerned about the loss of their jobs, and a tremendous amount of changes in consumer behavior, even though the government policies may no longer require people to stay in their homes. There's going to be a lot of changes in consumer behavior because of a combination of some restrictions by government policy on social distancing, the 2-meter rule, the 1-meter rule in airlines, public transport, restaurants, etc., etc. In addition to that, and probably even more importantly, changes in consumer behavior because people will be uncertain about whether there will be another phase of public health crisis. People will be uncertain as individuals about whether this will affect their health, and therefore they'll be cautious about going to restaurants, about undertaking certain activities and so on. I think even more importantly, businesses will be uncertain about whether there could be another wave of coronavirus followed by lockdowns, followed by losses of revenues. So whatever happens in the next few weeks, I think we're going to see very weak business investment, probably very weak consumption. I'm less sure of that. There'll be some pent-up demand in the next few weeks when people go out and buy, they go shopping, they buy clothes, maybe they'll buy, new computers or even new cars. But on a 1-year view, I think it's reasonable to expect that we will have much more cautious consumers as well as businesses all over the world. Now, the consequences of that for economic activity and for corporate revenues and profits all over the world are still completely unpredictable. I'm not necessarily betting that they will be disastrous. I don't think they will be disastrous because of the counter pressure that we're getting from the liquidity injections of central banks and the huge fiscal stimulus. But at the very least, we have to recognize that we are dealing with an unprecedented situation, and we can't make any confident predictions about what will happen beyond the next month or 2 months. In that situation, you would expect investors to attach a much higher risk premium of assets that are dependent on economic activity, consumer behavior, or business investment. And if the markets are not doing that, then I think they're making a mistake. And they're making a mistake because they're confusing, they've focused so much, so many investors in the last 3 months have focused so much on all the public health data, the coronavirus, will there be a vaccine, won't there be a vaccine, and so on, that they have been distracted from what the real questions are, and that is, what is going to happen to economic activity over the next 6 to 9 months? And until we have more clarity on those questions, I think it's hard to, at least I find it hard to see how this rebound in asset prices can be sustainable. And I think it's much more likely because of this analysis, but also because of past experience that normally bottoms, there is a retest of the bottom in a big bear market. I think it's much more likely that at the very least, we will have a retest of the sort of equity values we saw 2 months ago. The low point, I think, was March the 20th or 21st. Sorry, that's a very long answer, and I know it's not a satisfactory one, but I think this is a situation where I think it makes a lot more sense to be cautious than to be brave.
Yeah, actually, before I go to the next one, because I think it's a great answer. Thank you, Anatole, for going that deep into the answer. But perhaps because Gavekal has a huge exposure in Asia, and, and of course, if we look at the difference in timeframes in between, because the Western Hemisphere got into this mess 1.5 months, 2 months later than East Asia. From the evidence that you guys are seeing, from the evidence that Arthur is seeing in mainland China, for example, is there something that you could tell our Brazilian clients or U.S. clients in terms of what the evidence in terms of the recovery is showing us from that part of the world?
Yes. So when I talk to my colleagues in Beijing and Hong Kong, what they tell me is that, and I think this is very relevant to the rest of the world because everybody's been watching China because it's 2 or 3 months ahead in the cycle of everyone else. What they're telling me is that yes, that there has been quite a strong rebound in China in investment, particularly in low-end, small-scale consumer durable purchases. There have been signs of pent-up demand. So from the second half of March until a few weeks ago, there was a clear rebound. It's a rebound still to a level that is well below the normal amount of consumer spending, the normal amount of investment for this time of year. So the year-on-year change is still negative, but of course it's not deeply negative. I've got a few charts that I might show in a minute. So there has been a rebound, but they are very cautious because they're saying, yes, there was a rebound, but now things are slowing down because people are realizing that actually in China, much more than in the US, there's no unemployment, or in Europe, there's no unemployment benefit. And our calculation is that there are between 50 and 100 million people in China who have lost their jobs, as a result of what happened in the first quarter. Their incomes are not being replaced by fiscal intervention in the way that's happening in Europe and America. And they are, there was a return to spending, because of pent-up demand for 6 weeks, 2 months. And now that is stabilizing. And the only part of the economy that is really still growing very strongly is the investment sector. Now, this is very relevant to Brazil with, of course, the iron ore exports and so on. Infrastructure investment and real estate investment is rebounding pretty strongly. It's responding to lower interest rates, monetary injections, and crucially to the instructions from the central government that local governments should spend more money. So there is a rebound, but in our view, the experience of China suggests for the rest of the world that after the first phase, which will last about a month or so, of people going back to the shops and celebrating that they're no longer locked in, there will probably be a flattening out. That's well, now, and the big debate in China now, internally, I think much more important for them than what's going on with the US-China trade war or even with Hong Kong, is whether the Chinese government will inject significant amounts of additional stimulus or support to push the economy right back to a 5-6% growth path by the second half of the year, or whether they won't do it. And frankly, I personally expected that the Chinese government would do more fiscal stimulus as well as monetary stimulus, but that hasn't happened. So our view is that actually China has recovered, but it's not a V shape. It's the beginning of a V shape, but it could be more like a W shape recovery, where there's a rebound and then there's a slowing down, and maybe then there'll be another future rebound when there's more liquidity injections, more fiscal stimulus.
Great. Fernando, you want to take the next question?
Sure. No, thanks, Anatole. Thanks for now. I guess my question is linked to what you've mentioned so far, but a lot of people who are bullish the market are talking about very low levels of interest rates, right, supporting the market. Or there was a note from you guys this morning talking about the TINA model, right, and why the markets keep rallying. So could you elaborate on that? What does that mean? And yeah, maybe discuss this relationship.
So the TINA, this is what I was referring to earlier. The TINA means there is no alternative. This is what I was saying earlier about how the monetary intervention from the Fed mostly, but also the European Central Bank and the BOJ, is they're removing all these government bonds from the public markets, and we're talking huge sums of money, trillions of dollars of bonds that are being removed from the public markets, replaced with cash. That cash is initially in the bank accounts, in the pockets of investment institutions or investors. They have to do something with that cash. They're putting some of that cash further out the risk spectrum in the credit markets, which is, of course, what the central banks are trying to achieve, compressing credit spreads and so on. But a significant amount of that cash has to be placed somewhere. And the perception that a lot of investors have, and some people have mandates which don't even allow them to hold large amounts of cash. The perception is that they have no alternative. There is no alternative. If you don't want to put it into zero yielding or even negative yielding government bonds, if you don't want to take potentially quite a large amount of credit risk in exchange for a tiny amount of additional income, 50 basis points or 100 basis points, then maybe the only alternative is to put it into equities, or especially public equities. It takes a lot of time to put it into property or private equity and so on. So I think, so it is in that sense, well, at least the rational explanation that we can come up with is that it is largely a liquidity-driven rally. But where I differ somewhat from my colleague KX Tang, who wrote that thing, where he just analyzed the flows, and I think his analysis was quite right, is that I don't think that liquidity alone can sustain valuations in equities or in any other real value asset, whether it's equities or commercial property, in a situation where the cash flows that are required by those assets are inadequate. And so I think the big risk, and I suppose this is another thing that I should have said about this perception of a V-shaped, there's been a completely V-shaped recovery in asset prices, but there hasn't been any sign yet of a V-shaped recovery in economic activity anywhere in the world, not even in China, as I say. But the perception seems to be that, well, if we have a second quarter all over the world, which is completely catastrophic. So in the US, GDP will probably be down something like between 8 or 10% quarter on quarter. And the way that they express it in the US, as you know, they annualize it. So we're going to get a print of minus 40%, minus 30 or 40% in US GDP when that comes out in late July, right? But the perception is, well, if we get minus 10% one quarter, that means that by the third quarter, we're going to have a very strong recovery. We're going to have a rebound of 5% in the third quarter and maybe another 5% in the fourth quarter. And therefore, although this is going to be a very deep recession, it's going to be the shortest recession on record. It's going to be a recession that only lasts for 2 or 3 months. I think that's the psychology in the market. So investors say, well, if the recession is already over, then of course we should be buying equities, because you know you should always buy equities before the turn in the economy. But I think that is a mistake. It's a fallacy, because the only reason we're going to have strong growth, strong looking figures in the third and fourth quarter is because the second quarter is so catastrophically low. Even with 5% growth in the third and fourth quarter, by the end of this year, GDP will still in the US be something like 5% lower, between 3 and 5% lower than it was a year earlier. Now that's just a number. Who cares about the number? But the fact is, in that situation, you're going to have unemployment of 8, 10% at least, instead of 3 or 4%. You're going to have personal incomes which are much lower. Yes, they've been supported for this month, the next few months, but they won't be supported by the end of the year. So you're going to have much weaker consumption, much weaker investment than there was a year ago. And therefore, this recession will actually still be going on by the end of this year. I mean, the earliest this recession could genuinely end will be the first half of next year. And if that is the case, then I think it's too early to expect a rebound in risk asset prices when you've still got another 6 or potentially maybe 9 or 12 months of recession still ahead. But it will be a very unusual situation, because in the past, recessions have, are sometimes defined as 2 quarters of falling GDP, right? And as soon as the GDP stops falling, the recession's over. But that's not what it really feels like. Well, that's not what it means to businesses which have to operate on the basis of their current revenues and operating incomes. Operating incomes will continue to be very, very weak for at least the next 6 to 12 months. And I think that's that's the part of the calculation that I think investors are ignoring now, because they're just focusing on, or they're trying to get ahead of themselves by focusing on very high frequency indicators which show a big rebound in month-on-month activity. Of course there is, but that's from a level of 0. It doesn't mean that activity is returning to anything like normal, and I don't think it will return to normal until next year. Now, sorry, this is a very long answer, but the other point I want to make is that when activity does return to normal, sometime next year, if there isn't a second wave of virus and so on, then I will be very bullish again about asset prices. And the reason for that is that we will have eventually, sometime in the next 1 to 2 years, a combination of normal economic activity with still extremely abnormal levels of interest rates. So if you have a combination of normal economic activity and interest rates which are still at 0 or 1% or something like that all over the world, that of course does generate higher valuations, and not just for equities, for all kinds of risk assets, for junk bonds, for property, for commercial property, for commodities. The combination of normal sales with 0 or negative in real term financing costs is a very attractive one. Now, where I could be wrong in this analysis, because so what I have had, let me just show you, if you don't mind. I've had this way of thinking about what's going on, where I've said to people, look, there are 3 time horizons. The short term, which is really, really bad, and it still looks worse than the markets expect. Then the medium term, which is what I was talking about now, where economic activity has returned to normal, but interest rates are still very low. And then the long term, when we might get inflation coming back. Now, where I think this framework may turn out to be wrong is, and this may explain why the markets have been as strong as they have, and why I may be wrong in my bearish view. Maybe the market's really saying, well, actually, we are so enthusiastic as investors, economic activity returning, not this year, not next quarter, but maybe by the second half of 2021. And we are so convinced that by then, equity valuations will not be 20 times earnings, say, on Wall Street, but 40 times earnings on Wall Street. And that 40 times earnings will be seen by next year as a moderate and conservative level of equity valuations. We're so convinced about that we want to get ahead of that express train. We want to get onto that express train now before it moves ahead. That may turn out to be the right decision, but I think it's a very risky one because economic activity may not return to normal, it may take longer, and equity valuations may not go up to 40. They may still be at 20 because of the uncertainty of this unprecedented situation. And in that case, I think the markets have got ahead of themselves. And the liquidity alone will not be enough to sustain these levels of asset prices if we don't have a return to normal economic activity within the next 6 to 9 months.
Thanks, Anatole. And I actually, this dovetails perfectly for my next question that I had for you, because as you say, one of the main arguments in favor of remaining bullish that I've seen from investors all around the world is the latest evidence that appears to be coming out of from the pandemic in terms of the possibility, just the possibility, because we don't have data. Again, this is a new virus, and every day we learn more about this virus, but we still don't know a lot about it in terms of herd immunity thresholds and the R0s and whatever, and the policies that you need to follow to try to contain the different things. And I guess one of the main reasons why one would be bullish on the market is because one starts to forecast that perhaps the second wave of the virus, if and when it comes, is going to be much more benevolent than the initial wave. Basically, that we won't see the situation like what we saw in Italy and Spain, in which doctors had to tell people, hey, go die someplace else because there's no space for you here. That we don't see that kind of situation. And I have found that part of the argument is a very important one for people that are bullish on that. And it has to do with the apparent evidence that the serology tests are leaving from all around the world. That 43% of the Bronx already had the virus, et cetera, et cetera. So perhaps, I'm sure you guys are having this internal conversation at Gavekal all the time. And I would love to hear how you guys are addressing that difference, this discussion internally in terms of the bullish view and the not so bullish view vis-a-vis the prevalence of the virus and whether or not the second round is going to be horrible, is going to be relatively acceptable.
Well, first of all, before I answer that, when I will try and answer it directly, I think, Alberto, you've illustrated what I think is the misjudgment, the mistake that a lot of investors are making, because we'll come in a minute to whether the public health, whether the virus situation is really improving or not. But what I was trying to say earlier, and I'm sorry to repeat, but just to emphasize, is that even if there is no second wave, the damage done already by the first wave is, in my view, what the markets should be thinking about and trying to work out. How many airlines are going to go bankrupt, like LATAM, went bankrupt. How many hotel chains are going to go bankrupt? What's the next Hertz? How many auto companies are going to go bankrupt, etc. And how many people are going to be unemployed, even if there is no second wave? However, I think what you've described is absolutely right, and it's very natural human psychology. If people were afraid that they would actually might die, or their friends or relatives might die, and now they're calming down, they're saying, well, actually, this is not going to kill that many people, and I'm not going to be denied. Of course, there is a relief, and there's a relief rally, and I think that's part of what's feeding, I think, particularly retail investment sentiment, because the retail investors are much less bearish, in my impression, and according to some of the surveys, than the so-called professional wholesale investors, which incidentally is also usually a warning sign. When a lot of the buying is done by small retail accounts as opposed to big wholesale accounts. So for the retail investors, it's understandable that they're feeling, oh, well, it's not so bad. The world is not coming to an end. But I think that's actually a danger sign. Now, but what is our view of that? On the whole, look, we're not experts, but we've now spent a lot of time looking at the numbers and talking to clients who are involved in healthcare and pharma companies, things like that. I'd say our consensus is that the virus is turning out to be considerably less dangerous in terms of the fatalities, how dangerous it is to most of the population than was feared, and that seemed to be implied by the experience of China and even the early experience of Italy. But once the Italian experience is analyzed more closely, which it now has been, there was a figure they published yesterday that they found that 98% of the people in their sample of, I think, was 17,000 that they investigated in Italy, were either over, I can't remember whether it was 70 or 60, which for me is very important because actually I'm over 60, but under 70. But anyway, they were either in that older age group, or they had at least not just one, but at least 2 or 3 so-called comorbidities like diabetes, obesity, high blood pressure, etc. So for most people, this virus is not that dangerous. I think that's pretty clear, and we can all agree on that. And and I think that's evident everywhere else. But the other thing that is really encouraging is that it doesn't seem to be coming back in a second wave in a big way, when these extreme public social control measures are lessened. So we've seen in China, of course, it hasn't come back in a big way. In Japan, it just comes back in pockets. And in Europe now, I think Europe is going to be an even bigger case because obviously it's a more advanced economy and so on. In Denmark, Germany, it isn't coming back. So now we don't, I'm not an expert, nor are you. We don't know whether that's because the social distancing measures that are quite light social distancing measures, for example, like people just washing their hands or wearing masks and so on, are sufficient, and there was no real need for the extreme ones, like telling people you can't go outside and so on. So maybe even a small amount of social distancing makes a big effect, and that could be. Another possibility is that the virus itself is mutating and becoming less dangerous or less infectious, which also, and I think another possibility is that a lot of people have some kind of natural immunity, which is not necessarily picked up by antibodies to this specific virus, but just like young people are less susceptible to it, it may be that even among old people, there are quite a lot that maybe because they've been in contact with other viruses or colds or something are not catching it. So I think that, on balance, I would agree that the news flow of last month about the virus itself and the medical interventions has been very positive. And that's good news, I think, for Europe. I suppose the other factor is there may be a climate-related aspect to it, which is bad news, obviously, for you in the Southern Hemisphere. But it's really striking how the crucible for this experiment will be in the United States. Nearly all the experts, including Anthony Fauci and so on, in the United States said to President Trump, if you encourage all the governors to completely open up their states and abandon all these restrictions, you will get a really devastating second wave like they had in New York or Wuhan. And that just hasn't happened. And I think most people are surprised. So it is looking as if the virus is perhaps less dangerous than many of the experts and most of the politicians believe. I still think it's more dangerous than President Trump and President Bolsonaro believe it to be. But it could be that the second wave is not really a threat. But I think I still believe that even if there isn't a second wave, the world economy is going to be severely damaged by this for at least the rest of this year.
Great. Fernando, I guess.
Yeah.
Sure.
Can I get there are quite a few questions here from the audience, and a few of them touch on the point on that we haven't discussed yet. And what's your view on what are the consequences from all this money printing, right, that's going on in the world? And should we look at real assets? What's your view on gold, right, as a result, and real assets? And what's your view on this substantial level of money?
Yeah, thanks. So let me go back to this three-stage framework that I was talking about. We'll talk a lot about the short term. In the medium term, I think if we're lucky, there will be, and I think there's a better than even chance that there will be a pretty strong recovery by the second half of next year. And combined with low interest rates, that's a very, very pro-risk environment. That's a very good environment for equities, for property, for junk bonds, for emerging markets, etc. However, there is then a third phase, which is what I call, the long term from the middle of this decade onwards. And that's where I think, Fernando, your question about the consequences of all this unprecedented financial and fiscal intervention comes in. Now, of course, because it's the long term, it's furthest ahead, this is where the greatest uncertainties also lie. But one of the possibilities that we have to take, I think, very seriously is that we get a serious inflationary effect from the combination of unlimited monetary expansion and unlimited fiscal expansion, combined with a number of structural factors, which are also, I think, even before this crisis, we're in the process of reversing. So, a couple of months before the crisis, I was, in fact, it may have even been on my last trip to Brazil at the end of last year. But one of the points that I was making was that this was even before the crisis, that the 40-year trend of disinflation, which started in 1980, 81 with Paul Volcker, Margaret Thatcher, and so on, in Ronald Reagan, really seemed to be coming to an end. Partly because even before the crisis, monetary policy had become super expansionary, and central banks all over the world were no longer trying to reduce inflation, they were trying to increase inflation. But also because of a number of structural factors, globalization, the China price, huge deflationary force going into reverse because of the US-China trade war. Technology, possibly going into reverse because the disruption of technology was being replaced by monopoly power. Apple was a great disruptor, but now Apple is, Apple's business model, it's a brilliant company, it's a fantastic company, but how does it make money? It makes money by maintaining a monopoly and selling essentially the same product year after year, and each time raising the price by 20 or 30%, with a few little changes to it. So technology is becoming a factor of monopoly. But most importantly, I think politics, the shift in the balance of power between labor and capital, which has been continuous for 40 years, is already reversing. Now, demographics, I think, is less clear, so I'll forget about that. But if you think about it, each of these potential, each of these shifts from deflation to inflation, I think, are now being accelerated by what's happened. So my summary from that is that we are probably in the medium term moving into a more inflationary environment that is more similar to the 1960s, or at least the 1950s and 1960s, than it is to the 1980s and 1990s. And what happened in the 1950s and 1960s? The leading industrialized countries started out with enormously high levels of debt. In the case of the United Kingdom, 280% of GDP, way worse than Italy today, or Spain, or even Japan today. Even the US had a debt to GDP ratio of 150% of GDP. And they reduced that debt through a combination of rapid economic growth, but also higher inflation, combined with financial repression, in which their central banks continued to keep interest rates well below the rate of inflation for extended periods. That's what allowed them to get down their debts. Now, if you look at what the Fed has been doing even before the Corona crisis, the Fed has been keeping short-term interest rates continuously below the rate of inflation in the US. From now on, that's going to be a universal policy of all the central banks around the world. And what that means is that at least it's more likely, far more likely than ever before, that for the last 40 years, that we're going to be in a more inflationary environment. Now, what does that mean for asset allocation? It does mean that we have to start moving our portfolios, now not today or tomorrow necessarily, but we have to have a strategy of protecting our portfolios against the loss of purchasing power from inflation, and not just worrying about default risk and so on and so forth. And to do that, you have to buy real value assets. Now, is it gold? Maybe. Personally, I believe that a better structural inflation hedge is a real value asset like real property, commercial property, of course, in the right place. Industrial commodities, if you think that there's going to be a combination of somewhat higher inflation and a return to normal growth, they're extremely cheap. And equities. So I think this is why, in the long run, I think portfolios are going to become more biased towards equities, at least in the developed world. Now, of course, in Brazil, so on, it may be different, but they're going to become more biased towards equities and less towards bonds. That's what happened in the 50s and 60s when you had the so-called cult of the equity, when American, British, German, Dutch pension funds suddenly realized that they can't keep all their money in bonds because the purchasing power is collapsing, and that's what really led to the 60s big equity rally. So I think this is perhaps another reason why the equity markets are much stronger in the short term today than would seem reasonable on the basis of the arguments that I've been presenting.
Thank you,
Anatole. And yeah, but just to dovetail on that, let me tell you that we had a webinar with PIMCO as well, with CIO a few weeks ago, Anatole, and he had the same view that you have to just share it with us, and also advancing the conversation towards the possibility that in the next few years, one of the things that we will see is a de facto reduction in the independence of the central banks from all around the world, which is something that we all obviously need to focus on in terms of our portfolios going forward. And it also comes back to a very good question that somebody from the audience is asking us, which is that this person agrees with your views that probably we were going to go down towards levels that will make it more interesting to go back into the equity market. But his question is basically, once we retest those lows, how would you construct your portfolio at that specific point in time? I thought that was a very, very good question.
Yeah, and that's a very interesting question. I think particularly this week and today even, I mean, if you saw what happened today, the US stock market fell pretty sharply at the open. The fall was basically in the technology stocks, in the NASDAQ, the very narrow leadership that we've seen until this point. Those stocks, actually, most of them closed flat to down, but there was a big rebound in the cyclical stocks. So I think what I would do, and frankly, with my personal account, this is what I'm doing, is I can see that already there are a lot of potentially of high quality companies, whether they're financials or industrial cyclicals or so on, whose equity prices have fallen by 30, 40, 50, in some cases 60% in the last 3 months, and are still very, very near their lows. And those businesses will rebound and they will double again as soon as there is any reasonable chance of economic activity returning to normal. Those are the stocks that I think investors are starting to buy now on the basis of the more optimistic expectations. The problem is for the market averages, though, is that I think when those stocks start to rebound, the technology, the growth stocks, which are back to extremely high valuations and which are priced for not just an improving consumer and global environment, but for a perfect global environment, will lose their support. Because those stocks, the Apples, Amazons, Microsofts, the biotechnology stocks, have been bid up over the last 2 months since the market bottom on March 20th on the basis that these will be the survivors. These will be the kind of companies that will continue to do okay, even in a post-COVID lockdown world. But if the post-COVID world is turning out to be not that different from the previous world with normal growth but very low interest rates, then I think the cyclical stocks will rebound, whereas the companies that gained most from the last 2 months of panic buying, but very, very concentrated on the sort of businesses that are completely immune to the virus, those stocks will fall back. So I would expect, if there is a retest of the lows or something like the low, that would then lead to a rotation in which the cheap companies, the cyclical companies, will start to recover. And of course, the emerging markets, and we'll get leadership from emerging markets, possibly Europe rather than the US. An interesting thing that I just had drawn to my attention today is that in the last, I think 7 days or maybe 10 days, Europe has begun to outperform in every sector. European stocks have outperformed United States stocks. And I think that's another indication that we're now moving to a point where the markets can only be sustained by a rotation from the very expensive growth stocks to the very cheap cyclical and value stocks. And that could be true regionally as well.
Fernando?
Yeah, maybe I have 2 more questions. I'm not sure if we have time for 2, but what's your view on potential asset bubbles, Anatole? Because following almost every major crisis, right, we see some sort of asset bubble forming in the future. Do you think that's again a possibility? Consider what we just discussed about this unprecedented level of money printing.
Well, yes, well, very much so. Now, incidentally, I just put up this chart just to see, this incredible gap that has opened up between US and basically everywhere else in the world. And then you could do the same thing with growth and value. So I think, and this relates to the point of asset bubble. Yes, I think there's a very high possibility of an asset bubble. Now, the simple answer I can give you is not just a possibility, it's a fact. We are actually right now in the biggest asset bubble that the world has ever seen, in the sense that we have now something like 15, 20 trillion dollars worth of assets all over the world, which are guaranteeing to their investors that they will lose money, right? You've got negative interest government bonds, which have, if you're a buy and hold investor, you are guaranteed that you're losing, you're buying them with the guarantee that you'll lose money. And most of the people buying those bonds are actually buy and hold investors. They're long-term institutions who are doing it for liability management reasons and so on. So if that's not an asset bubble, I don't know what is, if people are flocking to lose money. If you then apply a rate of inflation to that, of maybe even a modest one like 3%, then you're losing a lot of money, on a 20-year negative interest bond, right? So first of all, there is already an asset bubble, and it is in the bond market. But the additional question I think you're asking, well, could there be could there be another bubble like the dot-com bubble or something like that, or like the property bubble in 2007? I think that's very likely. I think that's actually what we are seeing with the rebound in the technology stocks. It used to be the Nifty 50. There's actually only 5 stocks, I believe, that now account for 20% of the gains in the S&P 500. We are seeing a bubble in those invulnerable technology monopolies. Now, I said that I expect that there'll be a rotation from those to the cyclical stocks, but I could be wrong. What we could be, it's quite possible. In fact, the market behavior so far, at least until the last few days, suggests that what is more likely is a rerun of the late 1990s, where you had monetary, liquidity injections just driving up and up the prices of assets which nearly everybody knew. Certainly the kind of professionals thought, this can't go on, this is insane. These companies are never going to make money. Now, of course, this doesn't apply to Apple, but Tesla. Is Tesla ever going to make money? Is Netflix ever going to make money? Quite possibly not. Is SoftBank ever going to make money? For sure it's not. For sure it's almost certainly it will go bankrupt sometime, but that doesn't mean it doesn't get bid up in an environment of zero interest rates. So I think there is a distinct possibility that we will, the combination that I was talking about earlier of a return to something like normal economic activity, combined with zero interest rates, which are guaranteed by central banks for at least, say, 2 years until 2023, I think could well generate a repeat of the dot-com bubble and some other guys.
Anatole, we're running out of time, and we want to be very respectful of your time. We have about 2 minutes, and Fernando had another question, but I think that a bunch of our audience is from Brazil, and we would love to hear the house view on Brazil and the current situation, what you're seeing, what you guys are seeing, the opportunities that you're seeing, the risks, et cetera, before if we have time, we'll take one last one. Otherwise, we'll just...
Yeah, that was exactly my question, Alberto. And just to complement, there was a note from Gavekal, right, on the 12th of May, saying that you wouldn't run into a burning building. And right now, Brazil's best left to specialists, the crazies, the long-term opportunists, and those without other options like the locals. So,
yes. Well, talk about that. I look, and I can't teach you about Brazil. I go there to meet people like you and have a good time, and I love Brazil. But it's from outside. I think I would say there are 3 or possibly 4 problems, for Brazil right now, which are moving in different directions, and you can assess them. One is the public health problem. It's right now it's exploding. Will it end up being far worse even than Italy? It could be, and I have no sense of that. It does seem that the spread of the virus is not yet slowing down. Maybe it's flattening, but I'm not sure. So that's first, public health. The second thing is the political, and I think that is by far the biggest blight, the biggest negative for investors, certainly for international investors, about Brazil is the political situation, because this is something that we outside can't analyze And, judging by, some of the resignations from, the government that we've seen, and even these stories that even maybe Paulo Guedes might resign, even the people inside don't know what's really going on in politics. So, right now the political situation looks very bad. But when we focus on the economy, I think, there are two big problems. One is the general weakness of the world economy, and the fact that, Brazil is, at least from an external sector, is quite commodity dependent, quite cyclical beta play. And the second one is the strength of the dollar, which is also a big liability for Brazil and other emerging markets. Now, I think on the strength of the dollar, there is good news, and I think we're seeing a turnaround actually literally this week and last, and that is that the reason the dollar has been so strong, in my view, the most important reason has been the weakness of the euro. Because right now, although my colleagues believe, and I agree with them in the long term, that the renminbi is ultimately a replacement, a substitute for the dollar as a reserve currency, I think that will be true over the course of the decade. But right now, there's only one real alternative to the dollar, and that's the euro. And in any case, the euro accounts for about 50, and other European exchange rates account for about 50 to 60% of the DXY dollar index. So as long as the euro is weakening, the dollar will strengthen. There are signs now, and I think good reasons to expect the euro to strengthen, partly because of what we heard today. There is going to be an enormous European rescue package, which will help Italy and Spain emerge from this crisis, probably in a long term, a stronger form than they were when they went in. So if the euro strengthens, I think the dollar will weaken, because the dollar today is more overvalued than it has been at any time, certainly in the last 40 years. That's the red line there. So the dollar is more. Now, if the dollar weakens, emerging markets begin to enjoy a tailwind, a wind from behind instead of a wind from in front. In addition to that, I think that I think that's something that is clearly moving in Brazil's favor. And if you combine that with the possibility that the world economy, I think, will remain very weak, the demand for iron ore and some, even soya will remain pretty weak, but that investors, I think not now, sometime in the next 3 months, are going to start looking ahead to the normalization of economic conditions by next year, and therefore valuing cyclical assets and cyclical economies more highly than growth, or at least trying to take advantage of the very cheap valuations in cyclical economies rather than chasing the ever higher valuations in growth economies. I think that will work in Brazil's favor. So I think I wouldn't be recommending to investors outside that they should sell the cyclical emerging markets like Brazil today, either in equity terms or in credit terms. I think we have seen the low point in Brazil and other cyclical emerging markets in the same way that I think we've seen the low point in auto stocks, in financial stocks around the world. I don't think we've necessarily seen the low point in global equity averages, because a recovery in autos and banks will not compensate for a fallback in technology stocks and pharmaceuticals. And the same applies, to emerging markets. But I think economically, the worst probably is over for Brazil, unless you have another blow from either public health or politics, which I just can't predict.
Well, Anatole, it's already 6:03 in New York time. We thank you. We want to thank you on behalf of XP Investments and XP Investimentos in Sao Paulo and XP Europe in Europe. It is always a pleasure to have you with us. It's an honor to hear your views, and thank you for your partnership that has gone for a very long time. And hopefully the next time we do this, we'll do it someplace where you and I can have some coffee or something. But see, whatever the virus decides, we'll do. live will go on anyway. And thank you once again on behalf of everybody at XP for being with us. And to all of you that participated in our call, Ferreira, thank you very much. Caio, Andre, it's as always a pleasure. And thank you very much. And hopefully we'll see each other very soon. Thank you.
Yeah, thank you very much. And happy to do it this way as well. Okay.
Thanks. And thank you, Steve.